Welcome to Financial Modeler Lab, where financial concepts come to life in Excel. I'm Mohammed Rez, CMA and FMVA certified, and this channel is your go-to place for mastering practical financial modeling in Excel. Each video in this series is hands-on, no fluff, just real-world application. We'll cover key topics like revenue and cost of sales forecasting, fixed assets and depreciation under IAS 16, tax modeling, working capital, revolving credit facilities, equity and dividend schedules, all built step by step in a dynamic Excel model. Whether you're a finance analyst, accounting student, or a CFO, this channel helps you think, model, and present like a pro. We also draw from real companies, like BP, Rolls-Royce, and British Telecom, to bring theory to life. Bullseye, this is just the first in a full video series, guiding you through each component of a complete financial model. This video is the first in our fixed assets and depreciation series, where we'll break down key concepts and follow up with practical case studies built directly in Excel. Let's get started. First, what exactly are fixed assets? By the end of this session, you'll be able to identify what qualifies as a fixed asset, distinguish between capital expenditure and revenue expenditure, understand how depreciation is calculated and applied, explain how changes in estimates and policies are handled, and properly account for the disposal of fixed assets. Now, let's define the fixed assets. Fixed assets are assets with a relatively long life that are intended for use continuously in the company's activities, e.g., property, plant, and equipment, expected to be used over more than one accounting period and not held for resale. The long-term nature of these assets raises important questions. Can the costs be capitalized on the balance sheet as assets? Or should they be expensed? How should the capitalized costs be allocated to the accounting periods that benefited from the asset, i.e., how do we depreciate it? Recognition criteria. The cost of an item of property, plant, and equipment shall be recognized as an asset if, and only if, it is probable that future economic benefits associated with the item will flow to the entity and the cost of the item can be measured reliably. AstraZeneca, the British pharmaceutical giant, classifies laboratory buildings, specialized equipment, and corporate headquarters as fixed assets. These are capitalized and depreciated over time, as they support long-term operations. Once recognized, the next step is choosing the appropriate valuation model. After recognition, an entity shall choose either the cost model or the revaluation model as its accounting policy and shall apply that policy to an entire class of property, plant, and equipment. Cost method, where assets are carried at cost less accumulated depreciation and impairment, or revaluation model, where assets are carried at fair value, revalued regularly, with depreciation based on the revalued amount. The fair value at the date of the revaluation less any subsequent accumulated depreciation and subsequent accumulated impairment losses. Revaluation shall be made with sufficient regularity to ensure that the carrying amount does not differ materially from that which would be determined using fair value at the end of the reporting period. British Telecom, BT, uses the revaluation model for certain infrastructure assets. This ensures that the carrying amount reflects current market conditions, especially for fiber optic networks and large-scale installations. Let's now examine how to decide whether a cost should be capitalized or expensed. Capitalization versus expense. Capitalization is recording the cost of a good or service as an asset account rather than expensing the cost immediately. In addition to recording the acquisition cost as an asset on the company's BS, we can capitalize some of the associated costs. The total capitalized cost will be allocated to the periods that benefit from the use of the asset. When Rolls-Royce installs new engine testing equipment in its Derby facilities, the total cost, purchase price, transport, and configuration, is capitalized as part of property, plant, and equipment. After capitalization, we move on to depreciation, how we spread the asset's cost over its useful life. How much to expense each period. So, depreciation is a systematic allocation of the depreciable amount over the useful life, IAS 16.6, where asset costs are allocated to each period benefited. To calculate it, we estimate the acquisition cost, the useful life, based on economic value, not physical durability. The residual or salvage value. Note, estimate the useful life of the asset. The period over which the asset is expected to provide economic benefits to the company is not the same as the physical life of the asset. How much would it be worth by the end of its useful life? Estimate the residual value, salvage value, of the asset, an estimated resale value of the asset at the end of its useful life that is not discounted to its present value. Example: EasyJet depreciates aircraft over a 10 to 20 year span, depending on the model, flight hours, and market demand. These estimates directly impact profit and asset values. Now let's explore the three main depreciation methods. First, the straight line method. Depreciation expense equals asset cost less the residual value, divided by the useful life. Second method, accelerated, declining balance method, a method where larger depreciation is recorded in early years, less in later years, based on a fixed percentage of the asset's net book value at the beginning of each year. Depreciation expense equals depreciation rate multiplied by the net book value. Jaguar Land Rover uses the declining balance method for high-tech automotive machinery, which loses value quickly in the early years. Key characteristics: accelerated, matches assets that lose value quickly. Commonly used for technology, vehicles, equipment. IFRS, IAS 16, allows this method if it reflects the asset's usage pattern. Third, units of production. Depreciation expense equals number of units produced during the year multiplied by the depreciation cost per unit. Depreciation cost per unit equals asset cost less residual value, divided by the estimated number of units the asset is expected to produce during its useful life. If the machinery costs £70,000, has a residual value of £10,000 and a 4-year life, under straight line depreciation, the company would record £15,000 per year. Let's now consider what happens when estimates change. Sometimes, a company must revise the useful life or residual value of an asset due to operational or market changes. Such revisions are treated prospectively, affecting current and future periods only. Depreciation expense depends on the method used, e.g., straight line, declining balance, estimated useful lives, estimated residual, salvage, values. Why it matters: these choices directly affect net income. Comparisons to peers can be misleading without context. Always check the notes to financial statements for changes in estimates. Example: Microsoft UK revised its server depreciation from 4 to 6 years as newer infrastructure had longer operational efficiency. This reduced annual depreciation and increased short-term profitability. If a large-scale change in policies, instead of estimates, then might need to report new estimates for the prior years as well. Now let's contrast this with a change in accounting policy. A change in accounting policy, such as moving from the cost model to the revaluation model, must be applied retrospectively. This involves restating prior financial periods. Magnifying glass example: Company X recorded a building under the cost model at £1 million, depreciated to £850,000. Upon revaluation, its fair value was estimated at £1.2 million. The £350,000 uplift is recorded in other comprehensive income as a revaluation surplus. For the income statement, no direct effect, unless reversal of a previous revaluation decrease through P.L. Future depreciation, based on new revalued amount, not original cost. Now let's distinguish between repairs and capital improvements. Routine repairs and maintenance are expensed. They restore functionality but don't enhance the asset. However, improvements that increase output or extend useful life are capitalized. What if you spend money to improve a fixed asset? Capitalize the cost. If enhance the usefulness of the asset or extend the asset's useful life beyond the original expectation, then the cost is capitalized. Costs of improvements are added to the original cost of the asset and depreciated over the remaining useful life of the asset. Example: Tesco expenses the cost of repairing refrigeration units, but capitalizes the upgrade to energy-efficient models, as these enhance asset value and reduce long-term operating costs. Finally, let's discuss asset disposal. When a fixed asset is sold or scrapped, the company must remove the asset and its accumulated depreciation, record any cash received, recognize a gain or loss in the income statement. Magnifying glass example: if a company regularly sells production line assets that are no longer in use, the difference between sale proceeds and net book value is reported as a gain or loss. Thank you for watching. I truly appreciate your time and interest in learning with me. Whether you're a student, analyst, entrepreneur, or finance leader, your commitment to professional growth is what drives this channel. Stay tuned, because in our next session, we'll take everything we've discussed today and apply it step by step inside an Excel model. bringing fixed assets and depreciation to life through a real financial case study. If you found this valuable, please give it a like, subscribe, and don't forget to hit the notification bell so you don't miss the next hands-on lab. See you soon in the next video.